Moving averages, one of the most known technical indicator, but at the same time, the least, or rather I would say underrated indicator in the technical analysis toolset. Welcome to CryptoPie, the hub for transforming trading using technical analysis and risk management. I would like to discuss today about moving averages, which are very often mentioned in technical analysis toolset, and at the same time it is not used often, or traders tend to ignore it. And I can understand the viewpoint why traders tend to ignore it, because there are so many negative signals which come out of a strategy based on just moving averages. What we can see here in this chart are 4 moving averages, and I had briefly mentioned about this moving averages in one of the previous videos. The way I added this indicator was you go in indicators section, type in moving averages, and I selected multi-moving average with forecast. Once you click on that, it will show up over here. I will discuss about 3 other indicators which are built on moving averages or which work in conjunction with moving averages. The simplest thing, what you see very quickly, the easiest thing is when the trend is going down, moving averages, they slope downwards, and vice versa when they go upwards. When the trend is going up, they move upwards. Now this is very, very easy to notice, but at the same time one would wonder, how can I make a trading decision based on this? For example, if we look at the Bitcoin and USDT pair on a daily time frame, this blue line, which is a 200 exponential moving average, goes down and stays flat up until 15th of March. The bottom was somewhere around November, December. And also on 15th of March, you would not be sure whether the trend goes further down or it will start moving upwards. You will be only sure, or one can say with more confidence, that the trend has started going up at this point or at this point. And when the trading psychology kicks in, one might easily feel very bad about missing the bottom when we enter here, which is around 25,000 instead of 15,000, or one might enter here at 41,000 instead of 25,000 here or 15,000 here. So what is one simple strategy which is built on moving averages? And that is crossing of moving averages. Here there are 4 moving averages which are exponential moving averages at the length of 10, 20, 50, 100 and 200. Oh, there are 5. Sorry, I said earlier there are 4 moving averages. But yeah, never mind. Now 10, 20, 50, they are called slow moving averages generally, because they only look back. They're called fast moving averages because they only look back on the candles in the very recent past. Whereas 100, 200 are slow moving averages because they look back to 100 or 200 candles. It's not just about the candles why they are called slow, but they also make a change at a very slow pace. The way we saw it in this example, where 200 moving average started going in uptrend after the bottom has already been gone since many weeks. So the traders start using is somehow a balance between the slow moving averages, which are 100, 200, and fast moving averages, which are 10, 20, and so on. The problem with fast moving averages that they flip a lot as per the price action. Now keep in mind that moving averages are simply the derivative from the price action. Here the price action is open of the price of a particular asset, close of the price, high and low of the price. When I say close of the price, it means the price which was at the end of the day or at the end of the time frame. Now, what I mentioned was using the crossovers of moving averages. Let's maybe start with a small example of 50 and 100 moving averages. Let's hide the other three. All right. What we see here is the yellow one is the 50 and the 100 moving average is the green one. Whenever the fast moving average crosses above the slow moving average, it is seen as a potential bullish sign. And when it crosses under, so when this fast moving average crosses under the slow moving average, it is seen as a potential weakness in the trend, so a downtrend begins. However, here we would notice that since December 2022 there has been a strong uptrend in the Bitcoin price. So we mainly see some sort of consolidation or sideways movement in the moving averages, and it is mainly indicating more stronger or has been accurate in indicating uptrends rather than downtrends. But if you go slightly in past, when the bear market began for the year 2021, the fast moving average, which is the yellow line, when it crossed under the slow moving average, we could already see that it's a pretty strong downtrend. Now the question arises, how accurate are moving averages? For very strong trends, they are pretty accurate. But as soon as there are phases in market where the price consolidates or there is a sideways movement, then they tend to give a lot of false signals. So even the moving averages are very popular among traders to understand the chart. It basically helps to break down the chart in different sections. For example, here I can easily, just by looking at moving averages, I would say that there is a downtrend which is going from here till here, because the slow moving average is under the fast moving average. Sorry, other way around. The fast moving average is under the slow moving average. And now on the other side, likewise, the fast moving average is above the slow moving average, which indicates an uptrend. So the question is now, if moving averages are popular, why can't we use it? The reason is, in situations like this, where the crossovers are very often, and due to the sideways action, they are pretty unreliable to trade. The accuracy of moving average, the number of times you take a trade based on moving average, will often fail in a sideways market when someone is trading on a lower time frame like 1 hour or 5-minute time frame. We would see here either the entry points are too late or they would be on time but won't go in the trend which we are expecting it to. So what has been done in technical analysis, in the world of technical analysis, is there are additional indicators which are created based on moving averages. We need to note that it's not just exponential moving average. There are double exponential moving average, Hull moving average. I do not remember what LSMA was, but there is a simple moving average. There is triple exponential moving average, volume weighted moving average, and so on. There are various indicators which use moving average as the input, process that moving average, and then provide a bit more insights in the price action or the trend of the price or the strength of the trend. One of them I would say is MACD. This is an adaptation of MACD, but if we write MACD, it's moving average convergence divergence. And this indicator simply uses one of the moving averages. We can look into the code and see here that it uses simple moving average, fast moving average, slow moving average, and the difference between the fast and the slow moving average is the MACD indicator. And you find the uptrend and downtrend based on the difference between the signal and the MACD. And signal is computed by having a simple moving average over the MACD. If we look here in this section, just an example, we already see at this point that the trend was already weakening, and the moving average of course has told us from quite some time that the trend it's going in downtrend. But now I wish to enter a trade. I just know the trend, but knowing a trend does not imply I also know what is the entry point. Indicators such as MACD, where we see a crossover from the green bars to the red bars, can potentially become one of the entry points for taking a short trade. If we say that as soon as the MACD histogram goes below the neutral line or the zero level, let me hide this for better visibility. Let's hide MACD and signal and only keep the histogram. This gives me a very easy understanding of, all right, I can take a short trade here. My swing point is over here. I would like to keep it just slightly above my swing point, and my risk to reward will be 1 to 2. A very easy strategy. Using of technical indicators, any of technical indicators such as moving average, MACD, or any other adaptation is much better than trading without any technical indicators. Let's look at this chart without any technical indicators. If I would see it like this way, at this point I would have no idea where the market will be going. There is no indication to it. But now if I keep going further, all right, now I know the downtrend has begun. But what does MACD tell us? MACD already tells us at this point that there is a weakening in the price, which indicates there is a good chance that the price will be bearish from here on. We deselect this indicator, which is moving average. It also shows that the fast moving average is below the slow moving average, which is another sign of bearish momentum. Let's see these other two indicators which I have marked, and they are developed by the community using two indicators. So SAR indicator, which is this one. Let's unhide this. SAR indicator is basically PSAR is Parabolic Stop and Reverse. What we see here is that the Parabolic Stop and Reverse indicator signals us a buy trend, and then at this point it indicates a sell, again a buy, again a sell. It's a very noisy indicator. So such kind of indicators, one can be a little smart about it and not use it for buy and sell, but rather to use them as stop loss. We of course have swing points, which I discussed it in the previous video, which can be used as stop loss, but at the same time stop loss based on swing points are static. The price does not move along, so the stop loss does not move along with the movement in price. On the other hand, when PSAR is used, you can move your stop loss along with the price. So at one point, when your stop loss crosses your entry point, there is no loss, any more loss to be taken. So even if the trade goes against your expectation, your stop loss is above entry point. Therefore, there will be some profit rather than any loss. So this one is, in my understanding, better to use it as a stop loss, a dynamic stop loss, rather than a buy and sell. There are various adaptations which are provided in the community for PSAR. Of course, would be great to check them. But for this video, it's nice to just get a short introduction of PSAR. Here there is another one indicator which looks very similar to PSAR. Probably I just duplicated it. This one. This one here uses SAR and MACD, and it is slightly better than the usual MACD because in the MACD, pure MACD, the crossover of the histogram on the neutral line might be too early to enter a trade. That's why all these yellow histograms are indication of trend which has been formed. And as soon as you see a red histogram, you would notice that, all right, there is a trend confirmation. The momentum is going downwards. And on the other side, when it is a green histogram, the momentum is on the upside. There is, of course, one thing which one has to strategize is the balance between entering when the histogram crosses the neutral line or taking a trade when it's on the red or when the trend is confirmed. Because it can happen that by the time the trend is confirmed, it is already too late in the trend. For example, here, if we enter a trade, if I would have entered a trade here when histogram is green, that means I would have to enter here, and there is already a reversal within 3 candles. That's not a very good trade. There is not much room because on the 7th or the 8th candle, there is already a downtrend which begins. Therefore, I would say that using MACD, SAR MACD, or moving averages, these are some of the basic ones, but it is very important to build a strategy on which type of entry signals will be taken and which ones will be avoided. There are many other indicators, momentum indicators, trend indicators, volume indicators, which can be used. There are much more advanced ones which are the second or third derivative of the price action, and they provide slightly more confirmed information about the trend. And I find using technical indicators is fairly quick and easy to understand as compared to trading purely based on price action. Some traders might disagree because they have been using price action since many years. But I would argue if one is a beginner in trading or wishes to understand trading, then the use of these trading indicators is a very good step to onboard with trading and not being overwhelmed with various patterns in price action, understanding order blocks, understanding fair value gap, and 20 other terms which come along with trading with price action. All right, so that would be all for this video. I wanted to simply introduce a few indicators, or at least start with introduction of few indicators. I have already discussed about the swing point or pivot point indicator in the last video. Do check it out and drop down in the comments which topics or indicators or something in the direction of risk management which you would wish to discuss, and I would be happy to bring it up in one of the next videos. Thank you. Have a nice day. Bye bye.